Hey, welcome back to Fintelliq. So, here's a question I get asked a lot. If I invest sustainably, if I actually care about the planet and compares treat people, and I give up returns to do it. For years, the answer everyone assumed was good. You do good, you earn less, simple trade off. But that thinking is outdated, and today I'm going to show you exactly why using real institutional data and marketing fluff. This is sustainable and ESG investing, fully broken down. By the end of this video, you will understand exactly how it works, whether it actually pays off, and how to spot when a fund is faking it. Let's get into it. Quick to it. Quick roadmap so you know exactly where we headed. We are covering just 5 things. 1. The big mindset shift, the value versus values, and why that old trade-off idea is dying. 2. Actual the ESG framework broken into 3 letters explained in plain English. 3. Real ways investors actually implement this stuff. 4. The data. Does ESG investing actually hurt your returns or just help them? And the last 5 the greenwashing, because there's a lot of fake sustainability out there and I will show you how to spot it. This is 2026 market, the US market focused deep dive, and so it's current, it's practical, and let's build for people who actually want to allocate capital, not just feel good about a logo. Let's start with that first mindset shift. So here's the old school thinking, the legacy paradigm. This assumes that if you screened your portfolio for ethics, no tobacco, no weapons, whatever your values are, you are automatically accepting a discount on your returns. Doing good meant giving something up. Under this old view, ESG was basically a compliance checkbox, something you did to look responsible, not something that actually made your portfolio even stronger. And honestly, it often did restrict your investment in universe in ways that hurt diversification. But here's the shift. The modern paradigm treats ESG factors completely different, not as ethical restrictions but non-financial data. Signals about a company's operational resilience, its risk exposure, how long it's likely to survive and thrive. Think about it this way: a company that's sloppy about its environmental risks, treats its workplace badly, and has a weak board. That's not just an ethics problem, that's a risk problem. It's the kind of a company that gets blindsided by a lawsuit, a regulatory fine, or a supply chain collapse you did not see coming. So the modern approach isn't about restricting your universe to feel good. It's about expanding your risk mitigation toolkit, protecting your downside, and positioning yourself ahead of long-term trends. That's a completely different game. So why is this conversation happening right now? In specifically 2026, 3 macro big forces are there. The first, resource volatility. Energy and commodity prices are swinging hard, and the companies that have not hedged their exposure are getting exposed, literally. Second, supply chain complexity. Everything's global now, and that means sourcing risks is a real, measurable financial variable, not just an operations footnote. And the third one, regulatory transparency. Disclosure rules are tightening. Government want to know your carbon numbers, your labor practices, your governance structure. So companies that ignore this are going to pay for it later on, and though fines, though devaluation, though losing institutional investors who simply won't touch them anymore. So put those three together and you get companies that manage carbon, labor and governance proactively, showing something measurable at lower cost of capital. Translation: the market trusts them more and it's willing to lend and invest at better terms. That's not a values argument, that's just how markets price risk. And alright, let's actually break the open the acronym, because most people though throw away the ESG without knowing what's really inside it. It's actually having three pillars: the ESG one, the E stands for environment, the S stands for social, and G stands for governance. Now coming back to the point, E stands for environmental, how a company handles resources and the shift toward cleaner operations. S is social, how it treats people both inside the company and across the supply chain. And G is governance. So, how the company is actually run, who's accountable, and who holds the power. This is the whole ESG. Each one of these gets measured with specific real data points, not vague vibes. Let's go through each of the pillars at time in a one go, starting with environmental. E. Okay, environmental used to just mean, does this company recycle? Not anymore. In 2026, serious allocators look at specific measurable things: scope 1, 2, and 3 emissions. That's direct emissions, indirect emissions from energy use, and then emissions across the entire value chain, including suppliers and customers. That third one, scope 3, is huge and most companies still don't measure it well. Then there's physical climate asset vulnerability. Basically, in this, is this company's factory going to flood, or is it sitting in a drought zone? Water intensity, how much water does it take to make their product? And the circular economy integration, are they designing products or to be reused and recycled, or just being thrown away? Here's why this matters financially. Companies that ignore these exposures face rapid devaluation. Either governments hit them with carbon taxes, or physical assets literally get damaged or stranded. That's not a hypothetical, that's already happening to real companies today in the market. Next, the pillar which we are discussing comes social. S stands for social. This is all about how a company treats people, and honestly, the most human of these three pillars, we are talking supply chain, labor integrity, are the people making this product treated fairly, and even the suppliers down the chain. Data privacy protocols, how well does this company protect your information? Workforce retention, that means how well does this company, are people staying, or is everyone quitting after a year? And local corporate citizenship, how does this company show up in the communities it operates in? Here's the investor angle. High employee turnover and weak data security are not just HR headaches, they are early warning signs. A company bleeding talent or leaking user data is a company heading toward operational stress, lawsuits, breaches, and PR disasters, the works. So when you see a company with rigid, rock solid retention and strong data practices, that's not just nice to have, that's a genuine signal of stability. And finally, the one that we are here, the governance. Honestly, G for governance, this might be the most underrated pillar, but Lot of people think it's the most important long-term one. This is about who's actually running this show. Independent board configuration is the board full of CEOs, friends, or genuinely independent people who will push back. Executive compensation is leaders' pay actually tied to sustainable and performance targets, or do they get paid regardless? Dual class share limitations. Does one person hold all the voting power despite owning a small slice of the company? And minority shareholder protections. Can small investors like you actually get a fair shake? Weak governance is what leads to proxy battles. Activist investors storming in and institutional capital straight up working away. Strong governance is often the quiet reason of a company keeps compounding steadily for decades, while a poorly governed competitor blows up in scandal. Okay, so you now understand the E, the S, and the G, but how do investors actually put this into practice? So there are three real methods, and they are not the same thing. A lot of people lump them together, and which is a mistake. The method 1, negative or exclusionary screening. This is the classic approach. You just remove the entire industries. No defense stocks, no fossil fuels, no tobacco. It's simple to understand, but the downside is real. You can end up over concentrated in either certain sectors, and your portfolio can drift away from the benchmark in ways you did not intend. The method 2, that is best in class integration. Instead of banning an entire industry, you hold the best performers with each sector. So maybe you still hold an industrial chemicals company, but only if it's top decile on waste management and safety. This keeps your portfolio diversified while still regarding better run companies. And method 3, impact investing. This is the most direct approach. You are finding specific, measurable outcomes. Think green bonds, sustainable real estate debt. The idea is additionality, meaning your money is the reason that positive impact happened. It usually lives in private markets, so it's less liquid, and but the impact is very concrete. Three totally different tools, three totally different risk profiles. Keep that in mind because that directly affects the next section, performance. Okay, does ESG cost you returns? Alright, the question, does going sustainable actually cost you money? Let's look at the real data broken down by method because the answer is different for each one. Exclusionary screening. Cyclically volatile. When the sectors you excluded like energy have a big rally, you lag behind, and it carries high tracking error, meaning your portfolio moves quite differently from the standard benchmark. Higher risks of underperforming in certain years. ESG factor integration. This is the interesting one. It's consistent, it tends to match or even slightly outperform the broad market, and the tracking error is minimal. You keep your diversification intact. This is the method most institutional players actually lean toward. And targeted impact private equity, that's the last one, and highly asymmetric returns, meaning it really depends on the skill of the fund managers running it. It's liquid too, that's illiquid too, often locking up your capital for 7 years to 10 years. Higher potential reward, but you need patience and you need to trust the people managing it. So here's the takeaway, and I want to really remember this one: discipline, ESG factor, and integration, not blanket exclusion, is what actually protects both of your returns, and diversification. That's the sweet spot. So, now before we wrap up, I have talked about greenwashing because this is where a lot of investors get burned. Greenwashing is when a fund or a company exaggerates how sustainable they really are. Slap a green logo on the fund, call it eco, and charge you a premium for it, while the actual portfolio underneath barely changed. Regulators, including the SEC, have started cracking down hard on this. So, here's your due diligence checklist. Straight from this report, audit the data behind every ESG claim. Don't just trust the label. Confirm their actual third party assurance on their carbon metrics. Somebody independent check the numbers. Make sure the fund follows an established ESG compliance framework, not something they made up themselves. And never ever rely on marketing slogans alone. If a fund can't show you the receipts, that's your answer right there. Okay? So let's bring it all together. Sustainable investing has grown up. It's not a simple ethical checklist anymore. It's became a genuine sophisticated risk management tool. Here's what to actually take away from this video: move past superficial ESG labels and focus on real data driven integration. Treat sustainability metrics as indicators of financial resilience, not just good PR. Position your capital ahead of resource constraints and tightening regulation, because that wave is coming whether you prepare for it or not. And remember, best in class integration, not blanket exclusion, is usually what protects your returns. This is not about choosing between doing good and doing well. Done right, the ESG investing is just better risk management wearing a green label. Okay, so that's the full breakdown of sustainable and ESG investing, the frameworks and the real implementation methods, the actual performance data, and how to protect yourself from greenwashing. So if this helped you to understand your portfolio a little better, hit subscribe. Fintelliq puts out breakdowns like this every week. No bluff, they just the mechanics of how markets and money actually work. Drop a comment and let me know, are you already investing with ESG in mind, or in this changing how you will look at the portfolio. I will see you in the next one. Till then, bye.